Okay, you guys, this is being recorded, and I'm going to say it again and again. If you've heard it before, you're going to hear it again. One thing I say at the beginning of all these, if you're new to options or this strategy or even my teaching, watch this again afterwards as soon as you can, really. If you wait like a month down the road, it's going to be like learning it again. If you watch it again relatively soon, a day or so afterwards, it's going to stick into your long-term memory a little bit better. So you'll have that concept with you for a much longer duration. So watch it again. Anyway, my name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Started trading in college with a psychology degree and then decided to switch it over to finance. And after graduating, moved up to Chicago, sold all my investments, and bought myself a badge, jumped in the pit, and started trading. I actually started out like one of these runners back there in the background and jumped into the pits. But in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products, basically in all market conditions. Then I got to go over this disclaimer. Basically, it says any opinions, news, research, and analysis or other information provided by ProTrader Strategies and associated companies or employees is general commentary and does not constitute investment advice. I can't give you guys investment advice because I don't know what's in your portfolio and I don't know your risk parameters. Also, bottom line is do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. Sorry about the commentator voice there. Just after doing it so many times, I got to spice it up a little, right? Great picture of the cup. Yep. I'm not very good at French, so I'm not going to butcher that. All right. Anyway, you guys can follow me on Twitter at Wolfman's blog or our parent company at ProTrader Strat. All right. So this is the call diagonal, and I always call it the call diagonal because, for one, I want to get out of the way. This is a long call diagonal. Basically, we're going to be doing it for a debit. I do not do or recommend doing a short call diagonal, which is where you would be selling a long duration call. If you guys watch any of my stuff, you know when you're selling that option, you want it 35 to 45 days to expiration. So I'm not even going to go over a short call diagonal spread. I don't agree with them. So I'm just not even going to go in there. I've never, well, I mean, I can't say I've never traded one. I've never traded one since I've left the floor. How's that? Because it is one of the worst strategies ever. But this one is a good one. All right. So the long call diagonal. So just remember, it's the long call. And the reason why it's the long call is because we're buying a long duration option, which is going to cost us more than the short duration option. So it is by nature a debit spread. Okay. Does that make sense to everybody on that? We're buying a further duration expiration, and we're going to be shooting the perfect, or I can't, it's not perfect. The best case scenario for this long duration is usually around 65 to 75 days to expiration. The near expiration is that 35 to 45 days to expiration. Because remember, when we're selling options, I want to sell those options with the most theta decay that's going on. I want those options that I'm short to go to zero, right? Therefore, this is going to decay faster than these here. So we want to sell this, let it decay, because that helps us finance. It helps us pay for this in the money option. Okay. Does that make sense? Not even Tesla for this one. Good one. You've been watching the daily market commentaries. I'm along my 2-year put in Tesla. Phonetically, La Coupe de Stanley. There you go. Thank you for that. Anyway, so this is how we're going to try and set this up. And when I pull up the platform, everything will come together a little bit better. All right, our market assumption is, I throw neutral in there, and we aren't really neutral. We are bullish, for the most part, but we're not like extremely bullish, right? If we're extremely bullish, it's going to blast up through and the market does what we assume, and it blasts up, real fast. Then our short call option hasn't had any time to decay, so it didn't help us out. It's going to hurt us. So we want one of those boring stocks, where they just kind of trudge up slowly but surely, and not any massive volatility where it's spiking up and spiking back down, really. We just want one of those boring stocks that just kind of trudges up. So that's what we're looking for, but we don't want this to spike immediately. Okay, does that make sense? I'm getting blown up over here on the side. I'm going to have to slow down, I think. Let me try and get a couple of these. Thank you, William. Out of the money short call option finances the in the money long call option, correct? John, yes and no. Yes, it finances the part of the option, the in the money option has intrinsic and extrinsic value. Intrinsic value is really what that option strike is worth. Extrinsic value is theta decay. So only in the money options have intrinsic and extrinsic value because in the money options have value, right? Out of the money options at this point don't have value, right? If the underlying stays right here, they're going to be worthless. But those in the money options, an option that is in the money is worth what its value is. So for instance, if a stock is trading, we have a $100 stock and we are looking at the 95 put. Part of that 95 put is going to be intrinsic and extrinsic value. We want to finance the extrinsic value, that theta decay. So the option we're selling, that option hopefully decays worthless. And when that happens, then our in the money option has had the extrinsic value financed for it. So really we have it on for value. Does that make sense? We're not financing the entire thing, but we're just financing the part of that option that is going to decay. Should extrinsic value of the short option be greater than the in the money call options? CJ, great question. It can be, but know that when you are doing that, you have to get closer to at the money on your out of the money option to get more premium, right? There are some opportunities that I'm going to talk about when you have volatility higher in that option you're selling than the one that you're buying, then sometimes it will finance that nicely. But, it is the weight and balance. Do you want to be further away and have a wider spread, or do you want to lower your break even? Is going to be that question that answers whether or not you want to pay more of you want to pay all of the extrinsic and part of the intrinsic. Okay, so we'll talk about that a little bit more also. Is it accurate to say that generally you want to buy long-term options and sell short-term ones? That is a absolute general blanket rule. Sell shorter duration because you want that theta decay to eat away at your option, and buy those longer duration because then it gives you longer time to be right. You don't want when you're short, you don't want a lot of time on that because you have more time to be wrong then, right? So when you're buying options, you want more time to be right. So therefore go further out and you don't have that decay. All right, picking the right environment. With this one, I usually talk about high volatility, low volatility, and when to buy and when to sell. Okay, this is a little bit different in picking the right environment. What we don't want is a big discrepancy between the two options we're trading. Okay, in that the closer option, let me pull up the platform. This will be a lot easier to explain. If I can pull it up. All right. I got to shrink it. There we go. All right. And one thing I talked about at the beginning with that disclaimer is, you guys, I will be talking about stocks that I have trades on in, and I'm not trying to get you guys to do the same thing I'm doing. All I'm doing is talking about the things that I know and those stocks that I participate in and stuff like that. So we may very well go over a stock that that I have a position in, and I'm not doing it to try and get you guys to do it with me. All right, the bottom line. What we are talking about with picking the right environment is, see over here, we have all these different volatilities, right? We don't want a big difference between the option that we're going to be selling and the option we're going to be buying. And so, you know, I said 35 days is the best wheelhouse. It doesn't mean you can't do it inside of that. It's just where it works out the best, you know, with the theta decay and everything else. But we're still far enough out that we could get some theta decay here and take advantage of it. All the premium's not lost. So what we want to make sure is that the difference between this option that we're selling and this option that we're buying, the difference is no greater than 3 percentage points. 1 to 3 is great. Now, there will be occasions where this volatility in this June is higher than the July. And that's called backwardation. All right. You hear this always thrown out on TV, right? Backwardation, contango. The easiest way to remember backwardation and contango. Start with backwardation. It's backward down. All right. Meaning the back is down. The longer is down. All right. So backwardation means those further ones out are lower than where the current is. Contango, it's the opposite. All right. Usually volatility is in contango, but if we can find this volatility in backwardation where the June is higher than the July, that means there's more volatility in this front month than in this back month. So we're getting more for these premiums than we have to pay for these premiums in extrinsic value. Okay. Does that make sense for everybody? If there's more volatility in the one we're selling, that means we're selling the ones with the fattest premium, the juiciest premium. Okay. So when I say a difference, I'm talking about contango, where this is lower than this one, but by less than 3 percentage points difference. Okay. Because what happens is, if this is trading, you know, if this has like a 25 implied volatility, or 25 volatility versus 18, that's 7 percentage points difference. That means when we're buying out here, we're going to have to go further into the money and pay, get pretty deep in order to get less extrinsic value, right? So, and we're not going to be getting paid for selling these as much if the volatility is way high back here. So make sure on picking the right environment with this one. We're bullish in it. 3M, let's say, and we wanted to make sure this was right for it. We'd have to make sure that this is 18 to 20. That meets that rule. Okay, so no greater than 3% on the upside. But if this is lower, you're all good. All right, picking the right underlying. Picking the right underlying, you guys heard me say this, especially if you watch this time and time again. When we're looking at a stock that's over $100, move the decimal 3 ticks to the left. That's how wide the bid ask should be. So for 3M, we have, I'm right here, it's 25 cents wide, but you can see the rest of them are pretty tight and inside that 20 cents difference. That makes that fit that rule, picking the right environment. A stock under $100, these bid asks should be less than 10 cents wide. All right, so a stock under $100, 10 cents from the bid ask is the widest we want to go, or widest we want to see. Otherwise, we're going to go to a different stock and trade different stocks. You won't see many of these on this watch list that don't meet that rule I just talked about. There's a couple, and those are ones I just watched, but I'm not trading those options on those, right? It's just stocks I have interest in, all right? So under $100, 10 cents to the bid ask. If it's over $100, the easiest way to do it is take that decimal place, move it 3 ticks to the left. You can round up. It's close to 200, right? So we can say 20 cents. And you can see Costco for the most part, fits that rule. And we're looking at the ones, the monthlies with the closest to expiration, as long as it's not like, 2 or 3 days, right? All right, so the 20 plus days or more. Okay, we're not using that rule out here on the expiration cycle. Okay, we look for this because what happens is all these guys are going to roll out to this month sooner or later, and those markets will become tighter. All right. Plus, everybody's involved in here, and kind of not really watching this, but you start bettering this market. We say they're in the weeds. They're keeping an eye on it. They're just, the further out you go, the more risk you are, and that's why the bid ask is a little bit wider there too. Okay. I think I saw a question come up. Oh, being long Vega trade, we could put this trade on prior to earnings when the volatility gets pumped up. Absolutely. That's exactly where I was going to go, CJ, right after this. But I was going to talk about it in a minute. But yes. So, right now we're coming out of earnings season, and a lot of times coming out of earnings season, I probably should have flipped the diagonal with the calls because the calls are the calendar in a sense. But we're leaving right now. We're getting out of earnings season, right? And I wouldn't want to sell this option because I have too much risk to the upside. I don't want to put this on prior to earnings here. But if the earnings were, say, USO, yeah, good one, Eric. Pick USO for earnings. It's an ETF. They don't have earnings for anybody who missed that one. But if the option landed in here, then that would be perfect. Like we sell this option here in the clean month, that decays, and then we start seeing headed into this next earnings. You can see when you come into those earnings, you start getting those volatility spikes, right? That's exactly what's going to happen here after this expiration cycle happens. We're going to start seeing volatility or expiration, after expiration. Then this month is going to start seeing the volatility start to go up, right all the way up until that earnings event. And then you can see what happens after the earnings event. They get slammed. Volatility comes out. So in that, you can set this up heading into earnings, but I would recommend highly you get out of this option strategy before that earnings event, especially if you're wrong. If you're just slightly wrong, wrong, and it's right there where you're at, don't take that risk on a 50-50 shot. It's going to go up or go down. You got huge volatility here. And what can happen is even if you're directionally right, you could see yourself losing money because so much volatility comes out after that earnings, right? Volatility is created by the unknown. And once you have the known, there's nothing to worry about, right? So volatility will come out dramatically, and you could be directionally wrong with that long call and see yourself losing money. So get out of it, all right? Unless the other side of it is it's such a loser that you aren't even worried about it anymore. It's kind of like, I've already lost it right now, so I might as well just let it ride. And I've done that before too, That's something I've been directionally wrong, and I'm like, all right, we're at earnings. I might as well go into the earnings with this because I've got nothing to lose at this point. That's the only time that I'm going to go through an earnings with a debit or a option I own. Okay. All right, and then picking the right strikes. This is pretty important, you guys. One of those things we were talking about. We want to pay early on. I started getting early. Pay off the extrinsic value of that. One of the things you can do with this to start your search, like somebody was talking to me, you have so many rules, Wolfman, like how am I ever supposed to be able to put on a strategy? Well, there's always a strategy out there for the environment of an underlying you may be interested in. This one may not always work for that, okay? So you might need to go on to another one. But what I've tried to do with these rules is give you real quick ways to realize, is this call diagonal appropriate? One of the first things you do, you look at the environment. It's 10% difference. What's the answer? Not the long call diagonal, right? I'm not paying that much for that long put. So I'm trying to make this so you can quickly go through and discern whether or not this strategy is appropriate for the underlying you're looking at. Does that make sense? What is that? Directionally right or directionally ring? I don't know what that means, David. I'm missing your joke. Did you say that contango is front month and backwardation is back? Okay, so contango is when the front month is lower than the back month, okay? That is contango. Backwardation is where the front month is higher than the back month. And it can go for, you know, any type of futures and stuff like that too. They talk about contango and backwardation in the bonds and in equities and all that stuff. That's usually where you're going to hear it. We could use the strangle or the straddle. Is it long vega, long gamma? Well, that's all going to depend, if you wanted to use the strangle or straddle, where volatility is. That's where you're going to need to know your implied volatility and put that on. All right. And you're going to need a bigger move with especially if you're doing a long strangle or a long straddle, CJ, you're going to need a bigger move than what you would even be looking for with this. Because, right, with this one, we're looking for a long, slow kind of move higher. Whereas with a straddle or strangle, you want that to happen yesterday. Well, actually, the day after you put on the strategy. Even if you're directionally wrong, you could still lose out since so much volatility comes dramatically out after earnings. Yeah, if you're wrong, you're going to get crushed. If you're wrong, you're going to get crushed. But, you know, if you're right and the market moves higher, you could still see the underlying move quite a bit higher. And because of that volatility, you're actually watching yourself lose money. So keep that in mind as well. So picking the right strike. We want to pay for that extrinsic value. But one of the things I like to start with is with the front month and selling right around the 16 delta call, and then looking at the longer duration option and see where I can use that credit to pay for the extrinsic value of the option I'm buying. All right. Another thing is, do not pay more than 75% the width of the strikes. Now, if you followed all the other ones, like especially the environment one, it's going to be hard pressed to have that happen. But in one of those situations where I was talking about before, where, you know, if you're not paying for all the extrinsic value and the environment isn't right, where we've got that huge discrepancy, the back month is a lot higher than the front month. There have been times where I have seen where you're paying almost 95, even 100% of the width of the strikes. Don't do it. You have to be able to make a profit. All right. That's all risk, no reward in that scenario. So pay less than 75% the width of the strikes. This is kind of a check here, right? Because if you've picked all of these, this is gonna fall into line. So 75% the width of the strikes. So $10 wide, right? We wouldn't want to pay more than $7.50. Does that make sense? And then we're trying to make that extra $2.50 on top of it, right? Another thing is, when that short call expires, you can roll out in time. And if it's going against us, you can roll out and down, collect more of a credit. Just make sure that you're not going down too far where you're locking in a loss, right? I would rather not roll and just let it ride than lock in a loss. Does that make sense? Because if you have to roll out and down, yeah, you might collect a credit, but you could still have paid more than the width of your current spread. Don't do that. You can roll out and up as well, which increases the width of the spread and you're collecting more credit. So you're paying down, you're lowering your break even, and you're increasing your reward potential. All right. Did I confuse anybody there? Could you please repeat the delta to sell for the front month? Yes, I start with the 16 delta. And then I usually have to work myself closer to at the money. I start going down tick by tick in a sense, or option strike by option strike. But I start with a 16 delta, see what collection I can get. And then usually when you're going back into the next expiration cycle, you're usually picking about an 84 delta to get long. Okay, that's how it kind of works out. 16 delta, that means I have an 85% probability of success with that particular short, of it expiring worthless. And when I'm buying the 84 delta, that means I have an 84% probability that my underlying will be in the money at expiration by 1 penny, but that's where your probabilities come from. Okay, so we're starting off selling the 16 delta, looking back in the back month around the 85 delta. Okay, so we're trying to pair those up. All right. Okay. Picking the right duration. This goes back to what we were talking about. This is the kind of theta decay. This is the at the money calls. And yes, theta does decay differently at all different strikes. I'm just trying to give you guys a visual as to what happens to options premium. And you can see the closer you get to expiration, it accelerates. Further away, it's got really slow theta decay. So we are looking to buy the one with less theta decay and sell the one with the most theta decay. So we're going to be, like I said, the wheelhouse is like right around 75 days and 35 days. So 35 days to expiration, you get all of this theta decay happening really quick. And this is the one that you bought. It's not decaying very much at all. So if you sold this to pay off all this, this is going, when you originally sold this and collected a credit and you paid for all the extrinsic value out here, well, it still has extrinsic value out here, whereas this one is going to really decay to zero. But this one's still going to hold on to some. All right. See how we did that? We pay it off. We pay it off with this one, and then we try and get it to decay to zero, and then this one will still have a little bit of extrinsic value in it. And then if you roll out and up in time, you've increased your width, you've sold off more, lowered your break even. Okay. Does that make sense for everybody so far? My lack of clarity. If the UL moves higher in the direction of the long trend, won't the premiums go up as you get towards earnings? And to close it would cost more than the debit. What are we shooting for? That's what we're shooting for here, right? Absolutely. Yes. So as the underlying moves higher in the long trend, the short call, you would think that it's going to increase in value as it goes up. But remember, that's why we don't want it to jump straight up. We want a slow trend so that theta decay happens in that front premium. All right. And if we picked it right where we got that earnings cycle in the back, what volatility does, if we're getting, I can't find my cursor right now. If we're getting this kind of theta decay here, well, in this month, let's say it has, or in this option expiration, the underlying has an earnings. All right, let's just put an E there. It's got an earnings here. Well, what's going to happen is when volatility hits an option premium, what it does is it kind of starts doing this. And it can even start going back up. And that's what the premium value is doing because of what volatility does, right? So that would be the perfect case scenario, right? If we can get volatility to really expand on us, because that volatility really is extrinsic value. It's not intrinsic value. It's more of an extrinsic value component. So that would drive it up and hold those premiums off from their downslide. How many days out for the long call? My wheelhouse is usually around 75 days. We're just inside of that. I'm not too worried about it. But what I like to say it as, it's kind of like a yellow light in the scenario we're in right now, where you got to be a little bit more cautious. But if you're in that 75 days to expiration, 65 to 75 days to expiration on the long call, and you are short 35 days in the front expiration, then that is like the real green light. That's like, when you get all the stars line up for you, you're basically coming right into this theta decay. So you're further out of the money, and you get this theta decay. So you're able to capture that premium decay, and then you can roll it out in time. You don't have to take it all the way into the end of the day. You can roll it out and up in time. For instance, say I sold this for 50 cents and we're, 14 days to go and it's worth 15 cents. I might as well roll that out in time and try and collect another, 35 cents, sell another option at 50 cents. Well, my difference would be 35, right? I bought the one for 15, got out short the one for 50. So I've collected a total of 35 cents, lowering my overall basis as well. Right? Somebody's trying to call me out on something here. This is a calendar spread. No, this is not a calendar spread, because a calendar spread skips multiple expiration cycles. A diagonal is going from one main monthly to the next main monthly. That's the difference. A calendar is usually going to have 100 plus days to expiration at least, because you're skipping at least one full expiration cycle. Do we want to trade this trade to be long gamma? CJ, yes, that's for a different class though, but yes, you definitely can be doing, because the gamma is going to be jacking up in and around this area. So yes, you can gamma trade it for sure. And in that, you can even go through the weeklies. When you're rolling out, you can roll through the weeklies. Just make sure those bid asks are still pretty tight if you're rolling out in time. If you're going to skip over those weeklies, then basically what you're doing is when you roll out and up, you are basically just creating a long call spread, because it's going to all reside within the same expiration cycle. Does that make sense? So that's the difference between the diagonal and a calendar. Is a calendar you can roll out from month to month to month to month to month. Okay. And you could have 2, 3, maybe even 6 plus rolls through monthlies before you actually get to your option expiration from the calendar. Are calendars better to do? Well, if you are constantly in this market, I like calendars because you can continue to roll those calls out and continue to pay off and lower your cost basis more often than the diagonal. But anything can happen in the longer duration, right? I don't know that it's necessarily better. It has to do with your assumption. If you're long-term bullish in something, then I would go longer duration for the calendar. If you're thinking that, hey, we've kind of, you're using your Fibonacci and we've bounced off this low here and we're going to be heading into earnings and I think it's going to start wanting to rally, or, maybe it's a cyclical stock where whatever your market assumption is, put that into play. How long do I think I need to achieve this move? If it's short, if you think it's going to be a quick one, then I would go with the long call diagonal. If I was long-term bullish, let's say I love, Apple or whatever, and I want it, then I want it go long calendar, because I'm long-term bullish Apple. This would be more, I'm a short-term kind of thing, right? Amazon, yes, you could do that. So let me get through a couple more slides real quick, and then we'll pull up the thing because I get a little long-winded. So we did the duration, knowing your exit strategy before entering the trade, right? All right, paying no more than 75% the width of the strikes. We talked about that, right? So we've got that, and I don't know where my calculator is. All right, so what we want to do is no more than 75% the width of the strikes. Now what I do, therefore, is know what my profit is, right? My profit would be then $2.50. I usually shoot for around 50% of that. I have no problem leaving money on the table, you guys. I like getting in and out, in and out, in and out, in and out. Because if you can get in and out a lot, you actually are beating probabilities of options, okay? Because you've gotten out for a profit more times than losing, and it will work out in your favor. Believe me, over a long time, it will work out. The probabilities are the probabilities. So I'm looking for about 50% of that. So like we were talking about a $10 wide underlying, $7.50. Our max profit is $2.50. I'm looking to get out. I'm looking to get out for $1.25. So when the underlying's trading $8.75, or when this strategy is trading $8.75, that's where I'm looking to get out, right? Okay. Can I repeat the 70% logic? The 75% the width of the strikes. Yeah, I'm going to give a couple examples here in a second if I can get through all these real quick. All right, so our max profit. Our max profit is the width of the strikes minus that net debit we paid. We've gone over that a couple of times, right? One thing is the profit may be considered unlimited because if we let that short call expire worthless and we just left on that long call, well, it could go to infinity, right? So it is based on when we set it up, what we're talking about. Our max profit is $2.50 in those examples I was giving. Because I'm not looking to just ride this thing out forever. All right, max profit we went over. Max loss, debit paid. Anytime you pay a debit, that's all you can lose in options. That's the beauty. All right, the break even. Again, volatility can affect break evens. I'm just going to give you if everything remained the same, because if volatility starts spiking in my front month and not in the volatility comes out in the back month, you can see where the break even would differentiate, right? Because I sold a call that's now worth more. I'm losing money there, and the call I bought isn't losing money also. So the break evens, if everything remained the same, long call strike plus the debit paid is how we figure out our break even. And I'll go over all these examples real quick. And this is where somebody got a little ahead and threw out a stock before we had a chance for me to say anything, but I'm going to go with it anyway. She was just trying to move me along, I'm sure. Like, get on with it, Wolfman. All right, so Amazon was the first one I saw. All right, let's look to see where they have. Okay, the earnings probably isn't going to land in our cycle, but that's fine. We don't have any earnings. We don't have any dividends to worry about, because you do kind of have to worry about the dividends here, right? If the dividend comes out, the stock is generally expected to drop by that dividend. It is not a hard, fast rule. It doesn't always happen. Sometimes it does, sometimes it doesn't. But just know that the expectation is there. So be wary of that. All right. So Amazon. All right. We're clean, so we're good with that. So let's check out the trade to see if it follows the rules. We got 23.5 here and 21.5 there. So we got less than 2% difference. That makes that rule good. It's a $1,600 stock, 3 ticks to the left. Our bid ask should be about $1.60 wide. We're very close to that. It's after the markets, but you can see most of the times it will be inside of $1.60. So that fits that rule, let's say. Not every one of them does, but that's because we're after the close. So that works. Now I said we're going to kind of go out there and look for that 16 delta to start. because Amazon's a pretty hefty stock, normally I would lean to move in a little bit. On this one, I'm going to move out just a little bit. So this is the one we're going to want to sell. So we want to sell Amazon there. And then what do we collect? It's really going to be closer to $5.25. Hey, sorry, my dog is in the background making noise. So $5, that's extrinsic value, right? That's the out of the money option, extrinsic. These are the in the money options that we're going to be buying, and these have intrinsic and extrinsic value in them. So how do we figure out what the extrinsic value is? Does anybody know? What the real value of, let's say, the 1500 option is. All right? If you take the premium and add it to that option, we've got 1500 plus the, let's just call it 1290, 129, let's say $130 on the 15. So add 130 to this, that gives us 1630. 1630, well, this is trading only 1600. That means that there's $27 in extrinsic value that we need to pay for that option, right? $26 in extrinsic value. If I did that math right. Right? Now, generally speaking, it's not working out right now, of course, for this example. But what you can do is a floor trader hack, rather than going through all that math in your head or on a calculator or whatever, you can generally just look over here and say, all right, it's around $20, especially stocks that are, $100 or around $100. This is going to highly reflect what the extrinsic value of this option is. All right. CJ, look at the put for the same strike. Doesn't always work, but it gives you a pretty good ballpark of what you need to look for. But we're only collecting $5, so I'm going to have to go seriously. I thought it was going to be about the 84 delta. This is looking like I'm going to have to go way in the money on this one. So, I'm just going to hit this one so I don't have to mess up everything. So, oops. All right, let's do that. Sell that one. And then I'm going to change this option strike. I'm going to change the 14s to probably something like the 1380s. Bought those, sold those, 1380 plus the 228. So we've got 1606. So very close to where the underlying is trading. See how we're doing that? We're looking at trying to pay for that extrinsic value. I can easily double check to see if I paid for all the extrinsic value by figuring out where my break even is. My break even is the long call plus the debit paid. So my break even is $1,300 plus the $228 gives me $1,608, right? I did that in my math, so forgive me. So we're still even off by a little bit, I'd have to have a $5 move, which isn't unheard of for Amazon, but just knowing that it's up there, I probably need to move this down probably even further to see what that is. And it's 07, so it's not gotten that much better. So I'm going to walk away from this because I'm going to have to be really in the money, and I don't really want to pay that much for my diagonal, to be quite honest, right now. But you could do that. Play around with it, and because it fits all of those other rules. Anybody else have any other ones? You guys are blowing me up again, I think, anyway. Oh, no. Okay, I got everybody. All right, so another one. Let's look at a couple of examples where I saw some where they even had backwardation going on. So just to give you an example of it, because this is contango, right? Lower to higher contango. We want higher to lower to find a really good one. TIS. So AT&T, it's a $30 stock. So the bid ask should be at least 10 cents wide. It's actually 3 cents, so it's even in on that rule. So we've got AT&T there, 20 some days to expiration. Implied volatility, or the implied volatility here is 24, and down here it is 22. That is backwardation, backward down. That means there's more volatility here than there is out here. Why is that? Do they have earnings coming up? No. It's just a product of AT&T right now, most likely because we're probably close to the lows. People are like, okay, it looks like we found a bottom. And then they go in and start buying calls, right? Well, that's what we want. We want them to pump up those premiums and those calls because maybe we don't think it's happening right now. We think it's going to happen further down the line here. Or a slow, steady grind, okay? So that's what we're looking for, going for this AT&T. So I'm going to look at around the 16 delta-ish for this. It's looking like it's going to be like 30. I'm going to go with the 34.5 because these 13 cents, it's almost not even worth doing it. All right, so let's sell those and then go out here. 19 cents I got to pay for. So I'm going to go a little bit further in the money here, right? Because that's my extrinsic value of these options, you know, in a perfect world without having to do all the math. I can figure it out real quick this way. It's my break even is $32.79, right? We add the debit into the long call. That's our break even. So $32.79, and we're trading $32.79. So we paid for our extrinsic value. That means this option is worth really $32.78, right? But now this option is exactly worth where our break even is. If this option expired worthless, we paid for all the extrinsic value, right? All right. What? I don't even know if I know what the stock is. TWLO. Twillo. I've never traded it. All right. So $50 stock bid offer. I might have to look at this one. I might add this to the stock list. This is I don't even know what they do, but I'll trade it. I'll trade two raindrops against each other. I'm going to add this Twillo. All right, so let's take a look at it. Let's delete that one. And then, all right, so near the highs, this is the volatility crush. We do not want to ride this into the next earnings, right? Because that's what happens to your premiums. That's why I'm saying you could be directionally right. You could have been long calls here and gone into that, had that directional move, and because of that volatility crush, lost money, or at least didn't make money. T was good. Yes, T worked. I probably should have finished all of that stuff. Let's just look at it one more time before I get into this too much, because T did work. So where did I go? I went to the 34.5, sold those for 20 cents, went out here, bought the ones that were in the money right here. So 79, 78 is where the underlying is trading, right? So 29, so $32.78 there. Now what do? We got to figure out whether or not it is 75% the width of the strike. So we're paying $3.78 and divide that by the width of the strike. So that's $6.50. $6.50. And it's only 58%. Did I do that math right? It's only 58% of it. So that is a really good one. Oh, did I do my math? Oh, you're right. That's why it's not working. That's why it didn't make sense. $3, it's $5. Thank you for correcting me, John. Divided by $5.50. So 68%. Thank you, John. 100 years from now, somebody would be making fun of me for making that mistake. So 68%, that works. That's a good one. All right, let's go back to the Twillo. Twillo, come on, Twillo. Twillo, so we've already come up with the fact that it meets the rule of it's a good stock to trade. 42.60 here, and we got 42.19 here, lower. That means we're getting paid more up here. Let's start out with the 16 delta, so 59. You know, another thing you can do is look at your, I'm selling my short call there at the 16 delta 59. You can play around with it, like, you know, if you had Fibonacci extensions or something like that, or you saw a resistance area and you wanted to get above that, you can play that as well, you guys. You know, this isn't a hard rule that you have to sell the 16 delta. You're not always going to get a 16 delta. You don't have to get all that far away. You know, maybe if there was a major resistance at 57, you were like, oh, I'm going to sell the 57 and a half or the 58s. You can do that. All right. You can add in your technical analysis to these trades as well. All right. So we sold the 16 delta there, and then we're going to look to use 39 cents. So we go over here. We just kind of blanket around. I'm guessing I'm not going to get those much more than 39 cents, but let's just try it. 91. See, I'd like to be up here at the 85, but that'll work anyway. 18 to 13. So we got to get our calculator out again. Hopefully I did my math right. 1324 and 18 divided by 18. So 73. So it's under that 75%. So we're good. All right. You know, if it's 75.6 or whatever, 76%, you know, that again becomes like more of a yellow light, right? Where, all right, I got to be pretty sure of myself here, all right? Green light, you know, you're below 70%, you're in the 60s. That is a good green light as far as I'm concerned. All right. You guys, I guess it's a Friday. Jeez Louise, thank you. All right, sell the 16 delta. Buy the 13. There we go. Jeez. I'm sorry, you guys. All right, so thank you for that. I did sell both. This is long. We're paying a debit. 41 to add the 41 and the 1240. So we got $53.40, and it's trading 53.22. So it's slightly above us, but we can work with that. You can play around with these strikes. Maybe you would have to go down a little bit, but let's just take a look and see what the difference is here. 40, divide that by the 18, which is the width, and 68%. So even better. Thank you for correcting me. Apart from the assignment risk, well, you don't have assignment risk on the in the money call, right? And on the out of the money, nobody's going to assign you on it because it's out of the money. There's no value in it. So, or at least, you know, very rarely. I can't say nobody is. Somebody out there will. Somebody stuck me. You know, I did the butterfly webinar, and somebody stuck me with my in the money puts on the IBM butterfly today. That was a lot of fun. So, and you know, 20 some days to expiration. The guy's already putting me the stock. Come on. Anyway, so that works for that rule. Does that make sense? Short strike at the money. You're worried about if the short strike, if this market rallies up, and it doesn't happen overnight. It doesn't happen in the next 2 or 3 days, but it rallies up, and these short calls are at the money, and you're worried about assignment risk. For one, you've already got these 41 calls that are way in the money that, you know, you can just take assignment on those. That ends up being a little bit more costly. But if you start getting worried about that assignment risk and the underlying is trading 59, you know, a couple weeks from now, you are definitely at 50% of your max profit on that. You will be. So you're looking to take about 25% if 75% is taken as a debit. Right. If you pay less than 75%, then your max profit is that extra 25%, because your max profit is the width of the spread. So on this, $18 is my max profit, right? Or is the value, sorry, not max profit. $18 is the value of this spread. So at expiration, and the underlying is trading 59 even, this in theory should be $18. It's not always going to be, because think about it, a trader's not going to give you anything for free. It's going to make you give up a couple of pennies to get out. Okay, so that fits for that one also. And then let's do one other one. I'll do Love, which is Southwest Airlines. Sorry, brain blocked up for a minute. All right, so it's under $100 stock, and we got $15 wide here. Usually Love does have tighter markets. It could be just a product of it being after the close that they're a little bit wide. So I'd pass on that one right now. What happens if the underlying goes over the short call and takes it in the money? Well, if the underlying does, I would probably keep riding it out for a little bit to see if we can get some of that theta decay to continue happening, because even though that option is now in the money, right, it still has extrinsic value that needs to decay in that month that is decaying rapidly. So you can still see that happening if it's a slow move. If it happens like right away, you guys, then that's where it hasn't had enough time to decay and it's already there. So it's going to make it a little bit more difficult. It looks like a piece of garbage on the chart right now. What's that? Which stock? Love? Yeah, it's not, well, you got a confirmation here. One could say this is a nice place where people are wanting to buy it. Four-day week already priced in for options credit. Volatility does have a tendency to get pumped up into the weekend. And this is a 4-day weekend, because what we used to say on the floor, it's a rush to the Hamptons right now. Thursday before Memorial Day, Friday they didn't come in, because it was the first weekend at the Hamptons and everybody had to go. All right. Only because it went down today, right? All right. So do you guys want one more example, or should I start wrapping this up and let you guys get out of here? One more example? All right. One more real quick. All right. So we want to, let's look at another airlines. American Airlines. I went AAL. AAL. All right. So American Airlines. We've got 22 days to expiration. This one's in contango, this one's in backwardation, backward down, 33% here, 32% here. So that means we're getting paid more here than we have to pay here. That's always a good sign. Started around the 16 delta. I'm going to say that's the 47 calls. And then I'm going to look for around the 84 delta, like I said, right? 84 some odd delta for the buy. And we got to pay less than 28 cents. So let's just start out with this one and buy that one. So we have 36 to 47. That difference is 7. And we're paying, no, Eric, 4. That difference is 11. Sorry. I really need to go out and get real prescription glasses, I think. I'm going blind late in the days. All right, so 36 to 47. That is a difference of 11 still. So $8.30 some cents to 11. And let's do $8.37. Divide that by the width of the spread, which is 11. and that equals 76%. So it's slightly over. Did I do everything right there? 4, so 7 and 11 and 836. So, you know, this would be one of those. How old are you? I'm too old. 47. And I've been trading for about 25 years. So looking at screens and stuff, too many years, I guess. All right, so that would have been, this is one of those ones where I said, you know, it's 76, but, you know, you can do a couple of different things. I could go and say, all right, the one I'm selling, I'm going to collect a little bit more credit for it. Make sure that did change, right? So now we have a $10 wide, and it's, or sorry, yeah, $10 wide, and it's $8.20. It got worse. Okay, so you can play around with that a little bit here too. You can probably say, all right, let's go back to the 47, and I'll drop this by a little bit to go to the 35. Now we've got a $12 wide, $9.32. Add that in here. That gives us $44.32. 44.32. So we're getting this below. We paid all the extrinsic value and some of the intrinsic value of this, right? If our break even is below where the underlying is trading, then we paid for extrinsic value, which is good. So make sure it fits the rule, because we're buying it below. I'm pretty sure we've gotten the rule. So $9.32. So we got $9.32 divided by 12 now equals 77. 5 and 7 is 12. So it did get worse. So I'd stay away from that one then. Bad. You must be in your 40s then. Yes, that's true. And Nancy, there's no way I can even enunciate that. Great webinar today. Thanks, guys. I appreciate it. Thank you. All right, guys. You know, obviously, you got to do what you got to do, but make sure you educate yourself like you're doing now with this webinar. You know, that I still continue to learn, you guys, and try and better myself. But going forward, yet we have this deal for $36. Protecting your portfolio against rising interest rates. I know I pound on this all the time, but it is the part of people's portfolios they neglect. And in a rising interest rate environment, you guys are going to be very unhappy with the results of that part of your portfolio unless you start taking care of that today. History of options and everything else. There's well over 10 hours of option webinars here for $36. I'm sure that $36 will pay for itself in just this one little webinar here, but there's over 10 hours that you guys could take advantage of. I mean, you guys, I know you guys can go out there and learn how to do a long call diagonal or a diagonal spread, but they aren't going to give you these different rules to follow in order to increase your probabilities of success. They're just going to tell you, you go out and you buy a long duration call and you sell a short duration call. There's your diagonal. Go get them. Well, I told you guys, there's different scenarios where you could pay more than the width of the spread. They aren't going to tell you that because they don't know that that can happen. So make sure you guys take advantage of this because it is really how floor traders trade. And believe me, the reason why we know how to trade is because we got stuck with, I had to be short a long diagonal spread in knowing that was bad because we were market makers. We didn't always have the option or the opportunities like we have now where you don't have to take that trade if it doesn't work. When you're in the floor and in the pit, you got to take the trade. If you're standing there and the guy's looking at you, boom, you're getting them. So I know when is a good time to buy these things and when is a bad time to do all these trades. So, and I've come up with some rules for that you guys should take advantage of. So when you guys are using the right tools, you guys are going to be more productive and when you're more productive state of mind, you're going to be able to put on more strategies, which creates more opportunities and ultimately will build your confidence, you guys. And if this strategy goes against you the first time you put it on, don't just say, hey, I'm done with the long call diagonal. It's never going to work, because it went against me once. Just know the probabilities went against you this time. The probabilities will catch up over time and you will be successful. So make sure you're always thinking about probabilities. And if the probabilities gone against me, how many times did I get away with it before that they didn't go against me, right? And do that yourself. You will find out, especially if you are covering for profit early before expiration, you are going to see those probabilities of success go up dramatically. All right, would you spend a little more time for a leap on the long call? That would be a calendar spread, Wally, and I'm going to be talking about how to trade a calendar spread because it's a little bit different. You can't always pay those extrinsic values off right away, so I show you different ways to play around with that. And if it goes against us, if it goes down, I'm looking at that as well. But I will usually use technical analysis for stuff like that. But in that, if I get into this trade, for one, I'm not doing a 10 lot. If you have $100,000 account for something like this, I would probably be doing this because, the risk reward isn't there. $100,000 account, I'd probably be doing this as a 1 or a 2 lot. Very small, maybe a quarter the tranche you normally do, right? And that's on like selling options. When you're selling options, I do more. I sell more quantities of options than the ones I buy. When I buy, I'm buying a lot less. Nancy, what do you mean? You don't think you're going to do this trade? It's a good trade. I'm telling you, it's a good trade, especially for stocks when they're rallying. You're paying for the extrinsic value of that option. I do too, Nancy. That's what I usually like to do. I like to sell option spreads, but what do you do when you're kind of in between there, right? Nancy, you and I were cut from the same cloth. Nancy says, I hate buying anything. You are, and I'm a recovering futures trader. So that's where we separate. But anyway, take advantage of this. Oh, shoot, you guys, it's in the chat window. You can use that link at the top if you pause and type it in, especially if you're watching this on tape delay. This is good for only those of you who signed up for this webinar. So if you're watching it on tape delay, it is still good. But for the rest of us, it's basically for today only. But you can type this in, or it is in the chat window. So you can just link on that in the chat window. But Nancy, one thing, if you're always short premium, you are really one-sided on your strategies. And if anything goes wrong, things can go wrong quickly. So it's always a good idea to sprinkle in some of these other options, even though we don't love them, to make sure that we have covered all our bases. All right. All right. Anybody else have any questions? Nancy, I see you going in there. I can't read fast enough. All right. So take advantage of this. It's a great deal here, you guys. Also, later webinars, I'll be drilling down on different option components and how to trade those options. Trades I find when and where I find them appropriate, like those couple of those that I kind of vetted today. Actually, the one I vetted today, I think I only did the AT&T one. Here's also the link. Again, if you're watching it on tape delay, you'll have to pause it and punch that into your URL. Thank you for watching. Again, you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right. That's about it. You guys take advantage of it. Like I said, for $36, it's a steal. How long is it good for? Basically to the end of the week. Monday, I don't think it's going to be good anymore. Thanks, John. Appreciate Thanks, Andrew. Appreciate you too, man. Uh, that was fun. Good. I'm glad you liked it, Nancy, even though you didn't like the strategy. Appreciate it. But you should try it. Try it small, maybe even in a paper trading account, just to get used to it. Oh, it's good. You're good for good, Gary. You get all those. Gary's asking, no, how long after we buy it? Basically, if you take several months to get through all of those, sorry, I got the wrong thing going on here. Whoa, what's going on here? Where'd all these things come from? Sorry. All right, I guess we're going to the beginning. Basically what happens is on the website, you can go through and on each one of those bullet points, you can go and click on those. You can click on these. There's like a little box and you can check them off. So you have a long time to go through them all because it's over 10 hours of stuff. I'm not going to make you watch that in a weekend for sure. And you can go back and watch them again. Is the vertical spread a higher probability compared to the long call diagonal? No. The long call diagonal has a higher probability. You have more duration and everything else. Is there a trial that you're not getting? Nancy, reach out to us at trading@protraderstrategies.com. There might be something we're missing. Email us right away. Oh, you saw it go by. Is there an earnings one? Yes, I have earnings trades, earnings webinars for sure on all the trades that I do for earnings and how I set them up, like the timing and everything. Basically, you put on the long call diagonal whenever your bullish trend is in play and in between earnings, can't we? Yes, absolutely. You can play it in and around earnings. I don't like to go through the earnings with it because of that volatility, but I wouldn't suggest it. Does everything you present also apply to long put diagonals for the neutral to bearish environments? Well, yes. If I have strategies for neutral to bearish strategies and just neutral strategies. I go through all of those. I would say I basically go through every single strategy that I think is appropriate for people, right? Like the short call diagonal is not appropriate to trade. It's just, it doesn't make any sense. It's, in my eyes, in my mind's eye, it does not make sense to take that long duration risk like that on those short options and buy the short one. It just doesn't make sense. So do I regularly use this strategy? I probably use this strategy. I wouldn't say once a month, maybe on average, but when I use this strategy, it's right after earnings. I love putting on this strategy and the calendar spreads right after earnings. So yes, if you're watching the daily market commentaries right now coming out of earnings, that's when I start throwing these in there. So I do trade these regularly. Yeah. 4 times a year for the most part, because that's when it lines up, right? Right now we're coming out of earnings and we're heading into new earnings. And that's when we really want to kind of play that whole play. The best IV range for this strategy, is when you have somewhat higher implied volatility, zero. You're just not getting any extrinsic value, so you're going to be really close to at the market. So the real thing I want you not worry about implied volatility of that underlying so much as making sure the difference in that particular underlying's volatility in the options chain is no more than 3 percentage points. Remember when we were talking about this? Make sure that these are no more than 3 percentage points difference. That's the key. If it's over 3 percentage points, then you're paying a lot more for these options here than you're getting paid for the closer ones. But it will work in just about any implied volatility environment. And think about it. If we are selling an option to pay for this extrinsic value, we don't really have to worry about that so much, right? Because if volatility goes down and we paid for all that extrinsic value, it doesn't hurt us. He says the computer crashed that day. What's that all about? I missed something. LCD. Yes, I would close it just before earnings. The question, while he's asking, basically, should you close this before earnings? For sure. I think that's about it. He says his computer crashed that day. I don't know. All the orders were lost. Ugh. Does not sound like a fun day. I've had lost orders before, and that is not fun. All right. So, guys, take advantage of that. That's all I got for you guys. Have a great weekend. I will be working tomorrow, so some of you guys get to probably scoot out and go to your Hamptons. All right. So take advantage of that. Like I said, it's in the chat window there, or you can hit the link right here if you're watching it on tape delay. All right. Take care, guys. Have a good weekend. If you can't take that, take it easy. JQ must have cut out early.